Okay, so we had a look at the regulatory side of things and reporting and certain legislations and that's happening in the market. We're going to actually now have a look at certain acronyms or terms that are used in banking. It's quite important to know these because obviously when you're looking at people's CVs, if you're like me when you first start off in banking recruitment, is that you kind of scratch your head going, what does that mean? And you spend half your time on Google. Right, so the first thing we're going to look at is Libor. So what is Libor? Well, basically it's an interest rate that's London interbank lending market. That's how banks will actually use as far as an interest rate to actually transact with each other. Back in 2008, banks weren't lending to each other. That caused, that was one of the components of the financial crash. But ultimately the market that banks actually lend against each other as far as offering and accepting certain interest rates and loans between each banks is basically the Libor market. Another terms, if you're looking at banking, would be things like certainly at a corporate banking level, if you're looking at corporate banking CVs, is bilateral loans. And what these loans are basically a loan between one lender and one borrower. So that's where it's a straight transaction. Whereas syndicated loans, this is whereby you have one borrower and then you probably have one principal bank that's actually lending that, but it's syndicating the loan whereby other banks or institutions are actually taking pieces of the actual risk itself. But you have a bank here which is called an originator bank that's actually originating the transaction with his client but doesn't necessarily want to take the whole risk. So if you're, for example, General Motors, for example, and you want to raise, say, £1 billion, then what happens is you might have Citigroup might be your banker, and you say, Citigroup, lend me £1 billion. Citigroup doesn't want to say no, so it'll actually say, grand, we'll do the deal with you, but then go on a little road show and actually say, well, we have an investment grade organisation that wants to borrow £1 billion. This is the risk relating to its concern. Do you want to buy a piece of that particular loan? And that becomes a syndicated loan. Securitization, I think we covered that a few times, but again, just to understand what that is, that's whereby you're conversion of an asset like a loan into a marketable security. So a group of loans put them together and it becomes basically a security in its own right that can be actually marketed and sold on the stock exchange. Again, another contributing factor relating to the global crash back in 2008, relating to what banks were actually putting into those loans in the first place, or those securitized products in the first place. Okay, secured lending. This is basically whereby the lender takes control of an asset if the borrower defaults. So say a typical secured loan might be your mortgage, for argument's sake, whereby you're taking out a loan and you're putting the property up as security. So if you don't pay your mortgage, the bank can actually take back that asset. So that's a secured loan. So your loan is actually secured against an underlying asset. Whereas an unsecured loan, this is whereby the lender is actually lending money and the borrower is not pledging any capital relating to specific capital relating to money, should say assets that can be repossessed or taken charge of if the actual lender, or should say the borrower doesn't actually repay the lender. So that's unsecured loan. Bit of an accounting term, but again, you're going to see this actually on certain bank CVs, whereby he's actually taking first charge. And the first charge of a lender is the first charge on an asset in the event of a default. So, for example, when you have an organisation that, for example, goes under, then what happens is there's a mad scramble relating to those assets concerned, whereby certain banks would like to actually put first charge relating to the repossession of a particular asset that's held within a business. So if it's, for example, going back to the farmer who's borrowing money in order to actually buy a tractor, that tractor becomes a part of the farmer's assets. But what happens is it'll be written into the loan agreement saying that if the farmer defaults on a particular loan, that the first charge on that asset is a repossession. Mortgage, okay. Now we all know mortgage, okay. This is whereby you borrow money from a bank in order to actually finance the buying of a home. Again, it's a secured based loan. A lot of actual banks and organisations, mortgage-backed securities, would actually put these into securities products and sell them on. A lot of people didn't know that. Another thing that a lot of people actually don't know, that in old French, mortgage actually means death pledge. Okay, so It's kind of blatant, but what that actually means, it doesn't actually mean that you're pledging to die. What it means, it refers to the loan. So the loan is not paid off, and it's still live until the point that it's actually fully paid off. So a lot of people feel or believe that if the bank takes repossession of their home, that the actual loan is now written off. That is not the case. The loan's still actually in place. We're also looking at a thing called mezzanine finance. And what mezzanine finance is that, again, in the event of an organisation defaulting and it collapsing, the bank would actually put in a certain lending criteria whereby they'll, when the organisation is completely liquidated, the actual level that's just above the actual shareholders, as far as the last to be paid out is the shareholders, they're the level above that, and then you have superior bondholders or superior lenders at the top. A little bit more risky than secured lending is concerned, and at mezzanine finance you're going to actually charge a little more interest rate, so it's a bit of an unsecured lending side of things. So when you see mezzanine finance on someone's CV, you know it's a form of unsecured lending.